Hello everybody.
Hallo
My name
zusammen.
is Daria, and I've been working at Purpose in various roles for the last 4 years, and I'm currently an investment partner at Purpose Ventures. And I'm really, really thrilled to be moderating this panel today. And the panel will be in English, but those of you who don't understand English could also get the translation, so I hope you have a receiver with you. So what is the topic that we would like to discuss today, and why does it matter? Steward ownership seeks to challenge the relation between money and power and to decouple them. Also, steward ownership makes sure that profits belong to the company and challenges the question or asks the question, what is a fair compensation for founders and for the investors? And actually dealing with these kind of issues is not very typical for the normal or classical investments, but it is part of the discussion around steward ownership. And obviously, alternative forms of capital structures and investment processes are needed for steward-owned companies. But we at Purpose, we realized very fast that actually this need for those structures and for alternative finance is far broader and larger than just steward ownership. And actually it resonates with many, many stakeholders and different trends and different movements around the world. So today, we would like to observe what actually alternative finance is, what are the challenges and the opportunities of alternative finance, and also to speak about the question what the relationship between alternative finance and the principles of steward ownership are. So these are the questions for today. And I'm very pleased to have these guests here today, and thankful for having this extraordinary group of speakers with their different perspectives on the topic. So here's Corinne Gressle, Achim Hensen, Anja Ben-Ami, Astrid Scholz, Sebastian Klein, and also Oni Patton-Power joining us on the digital way. And guys, I'd like to ask you to shortly introduce yourself, just like 2 or 3 sentences, because most of the people have read your bios in the program, and also answer my first question directly. The question is, what brought you actually to the topic of alternative finance and steward ownership, and what is actually your role in it today? Would you like to start, Corinne?
Yeah, sure. Can you hear me? Yeah, good. Hi everyone, really nice to be here. Really nice to enjoy this amazing conference with you. Thank you guys for organizing it. My name's Corinne. I work for something called the Migros Pioneer Fund. It's a project development fund from Switzerland, privately owned. And what we do is we spend 15 million euros every year as grants that we're giving to courageous projects, startups, that are working towards a more sustainable future. And this is also what has brought me to the whole topic of alternative finance, has brought me to Purpose, because what we're doing, we do for impact. We don't get shares, we don't get money back. The only thing we get back from handing out these grants is impact. And we usually support our projects for 3 years. After this, we're out, and we're doing everything during these 3 years to make sure that our projects survive afterwards in order to maximize the impact. But actually, we have absolutely no control over what our projects do once we're out. We just trust that they follow their path. So sometimes it doesn't really matter how these projects are structured because they're so far away from an economic logic anyway. But sometimes we're supporting things that could get really successful. And that's when we start asking ourselves, well, is it right to hand out grants to companies that could get very successful afterwards? And if yes, how can we ensure that we make a difference, that we make sure that these companies grow in an impact-oriented way and not in kind of the more traditional capitalist way? And so I started looking for alternatives, because whenever somebody founded a classic corporation, I was kind of mad. And that's how I found you, actually. And we started talking, and then we started talking about how we can bring this concept to Switzerland. And so that's why I'm here today, and that's why I'm still very much into this topic.
Thank you so much. Would you like to continue, Achim?
Yes, happy to do so. Hi everyone, my name is Achim. I co-founded Purpose 7 years ago, and if the question is what's my path to steward ownership and alternative finance, if you had asked me 10 years ago if I would do anything within ownership or alternative finance, I would have probably said no way. That's not my piece of cake, because what my background is I'm a psychologist and I worked in organizational development for quite some time. And noted that everyone talks about purpose and everyone talks about self-determination. And I do believe that those two principles are extremely important for if you're interested in bringing out the potential of collaboration within groups of people, within people themselves. But if you don't combine those two principles on the ownership level, then it's boring for me. It leaves so much potential behind, and sometimes I think it's just fake if you don't combine it with a suitable ownership structure. I noted that very heavily when the company I worked for was sold to Axel Springer, and then everything is just words after that. And then that was my path to wondering, is there an alternative out there? And that was 7 or almost 8 years ago. And we started Purpose with the question, how can a more sustainable, more healthy ownership structure look like? And I was amazed by the two principles, by steward ownership, and then the alternative finance question is almost like the logical next step. If you implement the two principles and then have steward ownership, you have to wonder how to structure the investment. And then we thought, okay, why not try to do that as well? And started 2 investment vehicles, Purpose Ventures and Purpose Evergreen Capital. And both of them focused on investing in steward-owned companies. And Purpose Ventures, where I have a leading role, focuses on startup investments. And we've been doing that for the last couple of years, and the learning curve has been steep. And that's why I'm happy to have more experts around me to explore that, because I think those experiments are desperately needed. And what interests me most today is the combination, like where finance, ownership, and organizational design are designed in a coherent way to bring out the potential. If that's if the story adds up between those three, it's most interesting to me.
Thank you.
Yeah, thank you. Can you hear me, by the way? Yeah. I'm Aner Ben-Ami. I'm a founding partner at Candide Group. We're an investment advisory in the US, and we work with foundations, family offices, asset owners in the US that have a strong commitment and to want to see their capital working for deep impact and social justice. We've been doing it for about 10 years, have supported or directed capital to over 100 companies and funds, about $180 million overall. Within that, I have had the fortune of actually collaborating with Purpose on 3 transactions, 3 companies in the US that we led and helped convert into steward ownership. And our interest, I would say, my interest in steward ownership comes, I think before we even crossed paths, our approach was always framed as really thinking about the how and not just the what, right? So it's not thinking that it's not enough for us to just direct capital towards companies that have maybe a greener or healthier product, but we really have to kind of look under the hood, go into the plumbing and redesign how the system works, right? And because if ultimately our goal is to think about a better, more equitable distribution of power and wealth, so that other than again just supporting greener, better product for the planet, that we are also helping redefine who ultimately wins and who loses in that process. And to echo Achim's point on that, I mean, asking that question ultimately pretty quickly leads you to questions of ownership, and the question of ownership pretty quickly leads you to, well, then how do you finance it, right? Yeah. So.
Please.
Hi, my name is Astrid. I am one of the co-founders of Zebras Unite, a global movement for and by founders and investors who are building the businesses that are better for the future. 4 of us got together and wrote a manifesto in 2017 called Zebras Fix What Unicorns Break. And then we're shocked. Tens of thousands of people wrote back saying, I am a zebra, I want to invest in zebras, I want to build a zebra. So we invited everybody to Portland, Oregon. And fun fact, Purpose, I think, was our second corporate sponsor. for what was then called DazzleCon, our inaugural gathering, and where we very quickly decided what these self-declared zebras were looking for was capital, community, and a change in culture. I now head up our capital practice, which takes the form of not creating a zebra fund. People always ask us, when are you launching a zebra fund? To which my answer is hopefully never, because there are lots and lots of really exciting capital innovators out in the world who are building the funding vehicles and the financing vehicles that we need. And so we've taken a more sort of ecosystem support approach to capital formation. We have a tiny little solidarity fund that we administer out of the top line of our revenues, but that's not the big play. The big play is to imagine and figure out in different regions and sectors and demographics, what is the capital that is missing for companies that are better for the future, many of whom take forms of steward ownership or take cooperative structures or maybe remain nonprofits, and therefore have very different financing needs than sort of a traditional Delaware Sea, traditional under the finite, limited definitions of American venture capital. And so that's what brings me here and brings us to steward ownership.
Thank you. Would you like to continue?
Hey, I'm Sebastian. I'm an entrepreneur. I write and sometimes do angel investments. I'm currently one of the steward owners of NN Publishing, which is, surprise, a steward-owned publishing company. And also 10 years ago, I started a company here in Berlin called Blinkist, which took more the approach of the traditional venture capital funded startup. And what brought me to steward ownership and alternative financing is, first of all, I firsthand experienced what it's like to be an entrepreneur in a traditional or Silicon Valley style venture capital model, and that was not much in line with my idea of how companies should be and what entrepreneurship should be like. And then also one topic that really worries me is the global wealth distribution, and I think that most people underestimate what a big potential for societal breakdown that has. And I think that the traditional startup means venture capital combination is a good accelerator for that problem and doesn't help fix it. So yeah, when I came across steward ownership, I was easily convinced and am now happy to support the whole movement.
Great, thank you so much. So now, Oni, would like to hear something from you.
Absolutely. How wonderful. All right, hope that works. It's so great to be here with all of you. I am a author, so I wrote a book called Adventure Finance that actually features many of the people on the stage in looking at alternative forms of capital and ownership for companies. And I'm also an academic, so I teach at several universities, including University of Oxford, London School of Economics. And then I do a lot of advisory work, helping founders essentially to design new types of financing instruments. And then I am also an angel investor, and I'm trying to put my small amounts of capital to work in female-owned businesses where I live here in South Africa. And how I came to ownership, similar to Aner, was I came from the investing side. So I came into impact investing 12, 13 years ago when it was first starting. And the biggest question that I had as I was kind of helping to design some of these investments was, these don't look different. I guess that's not a question, that's a statement. These didn't look different from what I had been doing in my traditional banking and investing work. And so I really started on a journey, now 12 years ago, of trying to look at, well, what should impactful businesses that are receiving funding, what type of funding makes the most sense for them, and how do investors think about the type of funding that is suitable for the types of businesses that they are wanting to grow. And so really looking at, just as everyone else on the panel, saying that the current system is creating significant inequality, and just layering on impact is not going to change that. So really rethinking the types of capital that we are deploying into the types of companies and the ownership structures. And so that's really where I came from, and met Purpose and was immediately bowled over by the work that you're doing. and I'm very happy. I'm sorry I'm not there in person.
Thank you so much, Oni. Thank you, guys. And yeah, I prepared a couple of questions that I'd like to ask you. And yeah, so just please feel free and jump in and react to anything you hear and discuss. And that's going to be the first part of the workshop, and we'll open up the second part of the workshop for the audience, because I think people listening to us have lots of questions, so we'll give them the chance to ask those. Yeah, so Oni, my first question will be to you. You wrote this amazing book, you mentioned it, Adventure Finance, and you mapped out the frameworks and questions that could help entrepreneurs to design and, yeah, to design their funding journey, their very individual funding journey. So I'd like to ask you, like, how do you describe why is this so important, and why does the world really needs this type of capital, and how would you describe what actually alternative finance is and what it is not? Like, where's the difference, or where's the you know?
Yeah, and it's a great question. So what I always say is that we can't, and the panel already touched on this, we can't expect companies that are presented with only the traditional or legacy options of funding, i.e. venture capital, bank debt, grants, to be able to create new types of companies that are essentially driven by both profit and purpose. So grants are an exceptional tool, and I love working with them. I certainly work with grant funding and use it very strategically. And for instance, an example, as you asked, of what is alternative funding. So I've been working with funders around recoverable grants and forgivable loans, incredible ways to use grant funding. But grants are really not a very good tool to scale businesses. So that kind of leaves us with, well, you know, that we need more. Debt. It is not useful for most startup businesses. It is sometimes useful for small businesses, but generally not accessible. So that's one thing that is certainly not always very useful. And then venture capital. This is where we all think. Venture capital we use as, we say risk capital, and we mean venture capital. And as everyone on the panel knows, and in the audience, when we say venture capital, we mean a highly scalable, tech-enabled, exponential growth-seeking company, generally, let's be honest, founded by a white male. And that's what we funded. That's what 99% of venture capital has gone into funding. And whether it's entrepreneurs that say, listen, that doesn't make sense for me, I'm not going to kind of jump into that, or it's entrepreneurs that just can't access that funding. So do not have an opportunity to be able to grow businesses. And that's the scale of the problem. Billions and hundreds of billions of dollars that are needed to be able to address the SDGs, talk about the inequality, thinking about racial equity, gender equity. And the options that we have right now just don't work. So alternative finance is taking some of those types and expanding them and thinking about what are the ways in which we can adapt them to make them work. So looking at things like revenue-based financing as an alternative for debt or early stage equity. Things like redeemable equity, which is something that Anna has worked on as well, and Astrid, I know, and Purpose, you as well. Where can we sell equity but allow entrepreneurs and companies to buy it back, potentially even using it as a leverage to be able to take a small business and transfer it to steward ownership or community ownership. Looking at things like trade finance, supply chain financing as a working capital option, instead of having to go out and raise necessarily money from outside, actually working at your suppliers or working with your customers. So I know we have to use the term alternative finance, but the idea is that in the future it will not be alternative finance. It's just that we have this full spectrum of financing that we very rarely use the full spectrum of. The illusion that I give and that I allude to, in my book is Wizard of Oz. And, we see the world in black and white, debt and equity, and sometimes grants thrown in. But actually, we live in and can live in a technicolor world where the type of funding can suit the organization, the type of impact they're trying to build, and the type of company that they're trying to create. And I think that it's incumbent upon both entrepreneurs as well as funders to really seek out what are the right types of funding for them, and what are the things that can actually help them to be able to build the type of company, and not to be but the type of world that we're trying to build. And it's not going to be through venture capital checks that require exponential growth and are frankly really terrible from a gender and racial equity perspective.
Mm-hmm. And just to be a bit more specific, are there some patterns that you see in the deal terms when you compare alternative finance to VC terms?
Well, it obviously depends on the structure, but if we're particularly looking at a type of instruments that I like to call structured exits, which I completely and totally stole from Unner, by the way, we essentially are seeing deals whereby the founders have a viable way to own their company in the future and are not necessarily dependent on any sort of third-party exit. Unlike traditional VC, where investors go into a company and then there's some sort of exit event on the other side, and thus the company needs to grow exponentially to be able to get to that unseen event, being purchased by a competitor, having listing on a public exchange. These structured exit deals are having investors go in up front with an exit mapped out, a viable exit mapped out. Either the company repurchasing the shares, paying off the debt, borrowing money in the future to be able to purchase shares or pay off debt or satisfy the investor. But their need to then follow up this funding with more and more and more rounds at greater and greater values is not the same. So an investor comes in and they say, I'm looking for a 3 times return on my capital. And the way we're going to achieve that is that it's going to be from your bottom line over the next 7 years, or you're going to, at the end of 7 years, use the assets that you've accumulated to borrow money to repay me. It is not you're going to need to pay me an unknown amount of money in an unknown time when you list on an exchange. So it's really this idea of saying what's viable and what makes sense from a sustainable growth perspective, as opposed to just needing to look at an exponential growth perspective.
Mm-hmm. Thank you. I'd like to ask you, Astrid, what is your perspective, like the Zebra perspective on that? What would you say, why does this topic matter, and what is the difference in the relevance, like when you look at different stakeholders, why does this topic matter for them?
Well, zebras come in many different stripes, and so the capital needs to come in many different stripes. And where Ani talks about the Wizard of Oz, I like to make a comparison to an ice cream store, where, VC is the vanilla ice cream flavor, vanilla capital, because, it mostly goes from white men to white men, hence vanilla. Bank loans maybe are your strawberry flavor, and if you're feeling charitable, philanthropy maybe is chocolate. Imagine if that's all you could buy in an ice cream store. That'd be one heck of a boring ice cream store, right? And so what we need is, what we see in Zebras Unite is literally tens of thousands of entrepreneurs that don't quite have tens of thousands of unique business models or structural forms. There are absolutely patterns and clusters around companies that don't want to be unicorns. They want to be Mittelstand, right? They want to be the new Mittelstand, to borrow our Berlin chapter leads term, Yevgeny Kuris. And those are very ambitious companies. Or Anair, who's written about, using the analogy of playing Moneyball with a portfolio and a fund, right? Where you are growing, or you try to grow a number of, maybe they're 9-figure companies, not 10 or 11-figure companies. So there's plenty of ambition and plenty of variety and diversity in this community of companies that we're seeing emerge. And so the need we see is basically to then grow the capital that is responsive to that diversity of entrepreneurial appetite and innovation. And so at Zebras Unite, we've been leaning into the capital entrepreneurs And we've been leaning into the things that we can do to support capital entrepreneurs, right? Just to use one example, Zebras Unite itself is a multi-stakeholder cooperative. We're pushing $1 million or so in revenue now on the for-profit side. We cannot get a line of credit from the National Co-op Bank.
What?
We can get a grant from the National Co-op Bank to help them figure out how they can invest in other technology-enabled multi-stakeholder cooperatives, which is exactly what we're doing. So we're in a design process with the National Co-op Bank and a number of other stakeholders to figure out how these incredibly rich co-op banking institutions can, in fact, make investments. And I'm looking at my friend from Switzerland. You have a great co-op industry, right? But they don't know. They know food, right? Or they know electricity production. They don't know platform cooperatives. And so we're actively building a new capital instrument that is probably going to take the form of my working title for it is collective ownership, syndicated debt, cozy debt, because who doesn't want their debt to be cozy? It's not going to stick. But it's basically a new instrument that our friends at the National Co-op Bank and at various other financial institutions can distribute. So it's not an impact investing play. It's literally a new product that is being created to help catalyze a whole subset of this really interesting and diverse entrepreneurial ecosystem that happens to take the structural form of cooperatives. And so that's sort of the approach we take at this. Like, it's not alternative finance. We just need the flavors of capital to catch up with the flavors of entrepreneurial genius, and then figure out what's needed. Like, what are the new flavors that need to be designed and that we want to sell at some scale.
Okay. Yeah, the zebra movement developed a lot within the last years, and it's absolutely amazing to see what you achieved and contributed to this topic. And I'd like to ask you, like, how would you describe the trends that you see around this topic? Like, what is changing within alternative finance?
The topic being alternative finance.
Yeah.
Well, we're seeing, I think, and Ani has done a tremendous service to the field by describing in really intuitive terms sort of the basic taxonomy of alternative capital, right? So there's not, in fact, an unlimited number of flavors in my ice cream store, right? There are certain archetypes that are described really beautifully. And what we're beginning to see, I think, that is encouraging is people beginning to use some of the same language to describe some of the same things. That's really helpful, right? So that, because we get a lot of investors who say, you know, in fact, I've had conversations with potential investors who say, can you explain Zebras Unite to me in terms of a Delaware C company? That is a very sad statement. And we're beginning to get more people now who say, tell me about how I can invest in cooperatives, because they've, for example, already studied up. So I think we're beginning to see sort of an evolution in investor education, slowly but surely. And I would say on the founder side, we are beginning to see much more engagement with the question of what they want to be when they grow up. Right? So the minute you say, I'm not going to join the Y Combinator in Silicon Valley, you actually have to begin to ask this question of, like, what's my potential exit? And so we've seen a lot of interest in exit to community, for example. So those are some of the themes that I'm pulling on.
Mm-hmm. Sounds great. Yeah, Corinne, next one for you. You decided to actively integrate and introduce steward ownership to the startups you are working with. And maybe you could tell us a bit more about the opportunities that you see in this topic, like steward ownership, for your Migros Pioneer Fund.
Yeah, well, for us as a project fund that usually supports startup during their very first phase, so the money we have doesn't help anything if you're in the growing phase. We're usually there when you're funding, we're there in the proof of concept phase. And as I already stated, what we get back is impact. So for us, a concept like steward ownership is actually very interesting out of two reasons. First of all, and I think a lot of people need to realize this, legal structures are a crucial part of a sustainable society. of a society that focus on impact and not on profit. And nowadays, at least in Switzerland, I'm really sure other countries are at another stage there, but in Switzerland, there are not a lot of people talking about this. It's usually about the product you're doing, if the product is sustainable, if your intentions are focused on impact, you're set. Nobody is talking about your structure, or they're talking about it if you're going for a cooperative. But if it's a business, then it's a business and that's it. And I think it's a problem that we've neglected this part. And as a fund that's focusing on impact, we also need to focus on the kind of legal structures that that will be built with the money we're handing over to those startups. And then the second reason why this concept is really interesting for us is because it could act as kind of an insurance that will really maximize the impact our money could have. Because, as I already stated, we're usually supporting companies for 3 years. After this, we're out, we have no control. And sometimes it doesn't matter, but sometimes the companies could get very successful afterwards, they could get sold, we don't know what happens then. If we could found these companies in a way that the impact orientation is already built in a stable way, that would be a very interesting way for us to ensure that we get that impact. But then again, we're only at the starting stage, and if there is no system of alternative financial sources that is there for these companies after our stage, we can't do anything, because if I'm helping building up companies that go bankrupt afterwards because nobody wants to finance them because they're structured in a weird way and don't fit into the system, we don't have any impact. So we really need you guys.
Yeah, that's a really good point regarding impact investing, and that's a typical question that we at Purpose also hear. And that's also my question to you guys, where do you see the link between impact investing and alternative finance, and also impact investing and the question regarding ownership? Oni, you also mentioned the question, at this point, impact is not enough, it's not only about impact. And that was your point as well, how can you make sure that it lasts? So what do you guys think about that?
Guys.
And ladies, of course, all of you.
I mean, I would echo Corinne in saying that it's still a small part of the conversation, right? I mean, I think generally impact investing is still, in my mind, largely trying to apply the existing tools, right? The existing ownership structures and financing tools, just applying them to businesses for good, right? And then and then you hit all kinds of challenges when they scale, and questions around long-term adherence to impact, etc. So I think it is still in terms of our work, where that shows up is ultimately finding partners, right? Finding co-investors, because ultimately, I could say pretty much 100% of the cases, if an investor is organized in a fund structure, right? Venture capital fund, private equity fund, as long as it's not, I don't know, your fund, these structures are just kind of out of scope for them, right? So we need to find other investors like us that are willing to kind of take in investments on a case-by-case basis, think about this, what structure makes sense here, not try to kind of force everything into one box. I think people really need to just even though venture capital is so well understood and well known and prevalent, I think people have a hard time understanding the extent to which their model is just a complete deviation, completely opposed to this, right? It's all about pushing companies to extreme scale, right? Which means taking on more risk than they probably need or often should, right? In the aim or the hope that one day they're going to land somewhere with a massive exit and massive valuation. In the process, in the process, there is these structures that Ani mentioned around creating some sort of a capped return or some sort of a fixed return is just completely out of the question, right? It's the whole model rests on the possibility, remote possibility, low probability of making it big, right? So for us, really building a community of other practitioners that are willing to, I'm all for this notion that we can't try to fit all the universe of innovation and creativity and types of business models into just two boxes of debt and equity. And I think the first blog post I wrote about this many years ago was around the square peg and round hole. Like, we're trying to take all these different shapes and squeeze them into these two shapes, right? The debt and the equity. So I'm all for it, but I think the challenge is often for us finding other partners that can really innovate or can work outside of just a very tight box.
I'm a little bit annoyed by this impact investment tendencies that I see, and I try to put it in a nice way, but I would just wonder, like, how do you want to fix? They're also focused on fixing the problems and saving the world and reaching the SDGs and whatever, and you use the very system that everyone agrees is part of the problem of the symptoms that we see today, and you really smart people with a lot of power and money sit in a room and use the exact same system and call it impact investment and maximize profits and impact. And I just really think that is not the potential that we as human beings can reach to have that as a solution. So I would hope that impact investors really understand that without changing the structures, the how is that impact investment? I don't understand if you don't combine that with healthy structures. And from another perspective, more from a potential side, I think that the deepest impact that you can have is enabling people to take responsibility out of themselves and creating structures that enable them to act out of their impulses in terms of what do I want to create in this world, and then make it likely. I think if we compare very shallow impact to very deep impact, something like steward ownership or other alternative forms force you to deeply think about what is your relation to power, what is in a company for you, and what is money. And I think going to that level has a very deep impact, even if I cannot draw out your KPI and what SDG that draws to then in the end. But I think it has a fundamental, very deep, important impact to find your way there as a entrepreneur, investor, human being, team, whatever.
I think sometimes we make the mistake of treating impact investing as an asset class, and it's not, right? It's more philosophy that cuts across a bunch of asset classes. And what we're interested in is figuring out what are the truly new asset classes, right? Is it steward-owned companies, and what kind of capital do they uniquely need at the early stage, at the mature stage, at a conversion event? And how do we package those capital demands into products that frankly the mainstream financial industry can understand? Because I don't think there's enough impact capital. Yes, it's growing year over year, and it's a drop in the bucket against the deep pools of pension funds and sovereign wealth funds. So I asked my friend who works for the Norwegian sovereign wealth funds a few years ago, how do you invest in impact? You have this mandate. And he goes, well, we buy basically platinum LEED certified buildings in San Francisco and Singapore because there weren't enough funds and enough vehicles available for them to invest in. And so the question that we keep pushing up against is how do you create enough institutional grade investment vehicles that are tailored to this huge abundance of entrepreneurial genius again, and figure out what these new asset classes need to look like and how we can help catalyze them. And so that's sort of where we take this more sort of ecosystem approach to the creation of capital ecosystems now, that then ideally help with the handoff of any individual company along different stages and their different financing needs. And that's why we're so interested in to partner with Purpose and others in Germany, for example, around figuring out what are the critical capital gaps and how specifically in this jurisdiction, using debt and or equity type instruments, can we fill those gaps to then have that more catalytic effect. And I mean, if impact investors or self-declared impact investors feel like then they can come along, that's interesting, but it's frankly more interesting to figure out how this plays into sort of mainstream banking or, the economic development banks, the regional, yada, yada, right? Like that's much more, there's more capital on those balance sheets that could be mobilized.
I'd like
Daria,
to add
can I-
to the, sorry.
No, sorry, go ahead.
I just quickly wanted to add to the point you made about impact investment. I think a crucial point here is to look at where this money comes from. And often this money comes from people or companies that were very successful in the system as it is today. So these people, they believe in the system as it is today. And now they decided something like, oh, I'm going to do something useful with my money, so I'm going to use the great system that made me rich and use it for something good. So I think I would disagree that everybody knows that the system needs to change. I think a lot of people believe that we just have to include the right objectives into the current system and then everything will be just fine. And that's just not the case. And I think there is a lot of work that needs to be done. And we at Micro Pioneer Fund, we actually had the problem that when we started to introduce these ideas to the projects we support, that they then started to adapt the setup of their companies. They started to include stuff like, oh, we're going to reinvest at least 70% of our profits into the company's purpose. And what happened next? These guys, they went to impact investors to ask if they're going to get support later on. And they said, like, no, not with this weird kind of stuff you wrote into your company setup. No way. So what happened next? They came back to me and they were like, yeah, you told us that we should do this and then it's all going to be good. And now nobody wants to give us money. What do we do next? And that's a problem, right? Yeah. Because I want them to have a future. And there's really this mindset shift that needs to happen.
But I think it's interesting to ask, like, who could... oh, sorry, Ani, you were first.
Yeah, you would like to add something, right?
Yeah, so I think I couldn't, agree more. I really wish I was there in person. I really want to go out for drinks with all of you after this. And just
maybe next time.
Absolutely. So when I talk about impact investing and I like just how it's evolved, I really think of it in three stages. So in the first stage, when I got involved and many people here got involved, was very beginning. The question was, can we do good and do well? How much money do we have to trade off to create impact? And we moved after a few years into impact investing 2.0, which was, we can do good and do well. And we almost got very hyper focused on it, must do good and do well. And so then where I think we are now is impact investing 3.0. And it's had, as Astrid mentioned, kind of this bifurcation almost. On one side, it's this mainstreaming, must bring in, billions, trillions of dollars. So by some accounts, impact investors are around $1 trillion, which I always used to say drop in the bucket. It's starting to be a little bit more of a cup in the bucket. But on the one side, you have this mainstreaming, these giant funds, massive amounts of capital flowing into this. And then the other side, you have basically everyone here on the panel, which is asking these deeper, very systemic questions around, can we, to the point of, those that have benefited from the system, putting money, back in to try and still, earn from the current system is so spot on. And so I do think it's quite interesting how, and really very completely healthy to be asking the questions that we're asking now, which is, can the system fix the broken system? And I think the answer is pretty resoundingly no. But you have to it's this tension, right, as Astrid was saying, in the sense of we need to find ways to try and fix some of these really huge ways of capital being allocated, banks, development corporations, governments. And so I think that where we are is really this tension. And I hope that there's more, I hope that this stage gets bigger and there's more people that come onto this that are able to say the impact investing as we know it is not enough. Like it used to be, oh wow, impact, you're doing impact, that's great. But we have to be pushing further and saying how companies are owned, the way in which we're allocating capital, they're using the same types of tools. And I think that's where like there needs to be this agitation and this revolution within inside impact investing that is some people consider a revolution itself within capital systems. So we need to keep pushing further and be more radical.
Thank you.
Maybe I just wanted to contribute one small thought, because I think like from a consumer perspective and like a small early stage angel investor perspective, I think it's also good to look at that, like we're now entering a phase of greenwashing, like greenwashing and purpose washing. There's a big incentive for companies to just pretend being sustainable or purpose driven. Shell is now climate neutral. BCG is like a front runner in sustainability. I worked for them, so I'm pretty doubtful if that's so serious. And I think something like if I want to see if someone is serious, then I can either take like a lot of time to really try to find out, or I just look at the legal structure and the ownership structure, and I think that's like a good service to just be able to look at this and see if someone is really serious about it.
Thank you. I have one more question, a different one to you, Sebastian. You are an entrepreneur and also an investor investing into startups, and you have a very practical view on those matters. And could you maybe tell us a bit more about your experiences in financing steward-owned startups? Like what changes when you invest around those principles, and how is your role as investor role changing?
I have to say I'm relatively new to the game, so I don't have a lot of wisdom to share. And I think that like the early role as an angel investor doesn't change much. I think it's more like I hear many stories about later stages when then like the big investors come in and then everything changes. I'm hoping that, or I'm expecting that this is not going to happen. But yeah, that being said, I've never been invested in a company for long enough to actually see it, but that's what I'm expecting.
Anne and Achim, you have those experiences as well, right? With steward-owned companies. Maybe you could add something and share your perspective on that.
Yeah, first of all, I wanted to add that, I mean, it is hard today. It's not that you adapt steward ownership and you find investors all down the way and like everyone wants to give you money, because you do challenge the way how you structure it, and it is tricky for a lot of especially institutional investors who have their structures, how they do things, and they can't really break out of those. It's hard. It's super hard to do that today. That's why I think everyone who does that is doing truly pioneering work to push for them, for the next ones to make it a little bit easier. I think that's important. And there are a lot of open questions still. Like, I mean, everyone agrees kind of on the narratives and the concepts, but then like, what does it actually mean, and how do you do that in Germany? How do you do it in the US? What about the jurisdictions, etc., in Switzerland? So there's a lot of work at open questions, and there's not the comparable network of investors as the all mapped out VC system has. Let's be clear. But I can't compare to any years and years of investing before, because I started doing that within Purpose and within the steward-owned system. But what I think is special about processes that focus on steward ownership is that they ask the question of what is your role very precisely about the entrepreneur, because you are a role within the company, you're the steward. You have the power, you have the responsibility, and it almost focuses the investors as well to answer like, what is your role as an investor? How do you understand your role? How do you want to use as we heard earlier, the social technique of money to contribute? And I think there's not the one investor already today. There's so many different investors, so many different understandings of their roles and what they want to achieve. Next to just giving money from A to B, that's not the thing. I think it's about a relationship. And you have the role as an investor, and then there's the company, and you find out the relationship and your role. And being precise about that is a value in those processes. And I think it's different to just adopt the VC system and just talk about valuation and then sign a contract, rather than within those processes that are a lot more individual, and that creates a lot of potential for later collaboration if you do that at the beginning. Be precise about those.
Yeah.
Yeah, I guess I would just add, so definitely echo the fact that it is hard and takes a lot of work, right? The investments that we were involved with in the US and led, I don't think it would have come together unless we had really leaned in, taken a lot of time and effort and legal work to make it happen and help other investors in. And even in addition to that, before us coming in, there was already some considerable pre-work, sometimes supported by Purpose as a sort of like an advisor to the founder, to help figure out, like, navigate all the options, the governance options, is it revenue share or redeemable equity or profit share? Like, try to come up with a starting point even for the conversation with investors. So it is definitely a lot more work, harder. On the other hand, if it works well, I think what happens at that stage is you're already sort of creating this sort of alignment, right, and this sort of clarity of vision. And in our case, essentially thinking through, well, if this business goes well, right, if it kind of goes according to plan, what happens, and who benefits? How do you share value with investors, with other stakeholders? How does the kind of rising tide lift everybody, and everybody's sharing? Whereas, I think with some of these startups that rush to kind of quickly get the convertible note term sheet and then a higher valuation, they're kind of kicking down the road these questions, right, that sometimes then come home to roost, right, of, oh crap, I actually didn't realize that when I raised this round at a $300 million valuation, now if I don't grow my business 5 times this year, I'm essentially falling off the treadmill, and I'm going to have to probably give away ownership and maybe even get fired by my board. All these things will kind of catch up later on. You don't really think about, they're not written in the term sheet, they're kind of between the lines. You might not know. So, yeah.
Thank you.
Can I add one more thing? For me, it's important to not say, okay, steward ownership is good, everything else is bad, or other versions are bad inherently, and to make sure in our processes that people adopt steward ownership because they think steward ownership is what gives them the freedom to act in the way that they want. I wouldn't advise anyone to use steward ownership or anything close to that if they don't feel resonance and a certain sense of freedom to do that, because I think steward ownership is good. It's the thing you have to do today. And then you do that and you say, oh, it feels like a not well-sitting dress. I mean, we have started this work to create dresses that suit the founders in how they want to work. And if you now use that form and push that over someone, they cannot go out there and inspire investors, because they'll be like, I have this steward ownership thing, you don't want to give me money? But they need to go out there and be like, this is what I always wanted. This is how it creates value. This is how I want to act, and create a certain amount of, like, do you want to join? Because this is a great thing. And then you can be this pioneer, but not with just adopting it because it's a new thing and you haven't really understood what it actually means, etc., etc. So that's an important part of our process, to make sure we feel this resonance out of the founders themselves, that they want this as their dress, as their way, because they want it.
And this is basically a kind of link between steward ownership and alternative finance, both looking for solutions that are really specific for the companies and are really suitable for specific companies, and not like one size fits all. Yeah. Well, okay, thank you so much. I could continue asking you questions for hours, actually, because I have lots of them. But I actually would really like to give the chance to our audience to ask you questions as well. And I think there are also people sitting here who also have an opinion on that and who have great experience with this topic. So you could also just give a comment instead of asking a question. Go for it. And we have a microphone. I think we have to give one. Right? And then we'll share the one on the stage. Okay.
I think we only have 2.
We'll get one.
Right.
Mm-hmm. So, yeah. So maybe we can start here, and then the microphone is coming, and they'll try to listen. Okay.
Let's wait for the microphone, otherwise they will not understand. I think we had that the other day, yesterday.
Okay. Okay. Please.
Thanks. Hi, my name is Simon. I have a maybe more practical question, maybe to you only, if I may. So if I'm a founder of a purpose company, maybe I build a product, so I have a couple of years developing, investing, and if I then take money from investors, how do I define when and how they get their money back? Because my understanding so far is if I kind of refer to possible profits in the future. As a CEO of a purpose company, I don't have any real incentives to generate profits. Even if I could calculate them, I would rather reinvest them or say it's just resource for later. So I think I mean, if there's like a personal relationship, that could be on trust, but if I want to collect serious money from institutional investors, I think that's not enough of a promise. But then if I define like a percentage of my revenue doesn't indicate if I really have a successful running business. Even growing revenue doesn't have to mean that. So do you have any solutions to that or any experiences so far?
Is it a specific question to someone?
Is that on you, right?
To me.
Yeah.
If you may. Thanks.
So yes. What I would say is that you are going to have to. So for instance, if you take money from an investor, I would say the type of situation you described would be likely something that we call, or that I call and others are starting to, redeemable equity, which means that you could sell shares in your company, but with the ability to buy them back. Now, you would have to be willing to, in the future, set aside a certain amount of your profits to be able to repurchase these, or you'd have to be willing to borrow money to be able to repurchase these shares. How these contracts generally work, whether they're kind of more debt-like or more equity-like, is there is a determined amount. So if someone, for instance, invests $100,000 and you commit to repaying them 3 times that, you commit to repaying them $300,000 in 7 years. So you would know early on what you were working towards, and you needed to either borrow money or you could take it out of your profits. You could set aside a set of profits over time to be able to do that. So these types of deals, generally the organizations have to have some sort of margin. So you'd have to have some sort of understanding of the type of capital, as you said, that you could be profitable over time. If it's a percentage of revenue, from a redeemable equity perspective, it still needs to be more like a dividend. So you still would have to be profitable to be able to, pay that out. But I think the fundamental question that you're asking is, what is your company going to look like from a profit and loss in the future? There is no type of capital other than a grant that you can take out without having some sort of repayment requirement or ability to make an entrepreneur, make the funder whole in the future. So you will need to, even as a purpose-driven founder, you will need to have an understanding of the reserves. Now, you don't have to pay those reserves out to anyone, but you could set aside a fund that essentially is saving up for that $300,000 to be able to pay out that investor, and that investor then would exit the company, and you, or essentially the steward owners, would continue to own that company. And that's something that multiple investors are working on, even within kind of the co-op steward ownership. People around the table here that have done it, and others are looking at how do you provide what looks like equity funding into companies that don't have any desire to take on kind of open-ended equity. This is in essence closed-ended equity that you would say has a repayment amount and potentially a date, and as a company you'd be able to plan for that.
Thank you.
Mm-hmm. Here?
Down the line.
Hello, everybody, and thank you for an inspiring discussion panel. It's really great to listen to you. I have a second thought, in addition to all the things you said already, that's about time and timing of capital. So we are a little startup. I'm not telling anything about that, but I think that the capital you're looking for has a certain color for your business. So for purpose-driven companies, I think it's even harder to have the time to look for someone. I mean, you have a business to run, and in the beginning it takes a lot of time. And as a purpose-driven company, I'm not looking for as much money I can get to make as much money I can have out of it afterwards. I just want the money I need. At the moment, I really need it. So, and if it takes such a long time to get some money, it's really a question of time I have to do that and the timing. So I talked to a lot of people about that question, and my idea, it's a very basic idea, is a little bit like you said, Astrid. I'm a big fan. I'm a big fan of you. As you said, it maybe needs a different instrument. And there's not a word for it, so I don't want to say fund or something. But maybe like what you call, like in Germany, umgekehrter Generationsvertrag. So it's a reverse generation contract, and it exists already for students here. So you get money the moment you need money, the amount you need, and preferable found the amount with experts which are on your side, and then you use the money, you build your business, and you sign a contract, and you pay it back with some, whatever it is afterwards. Because I think like all the instruments we have at the moment, they don't fit. They just don't fit. So your thoughts about this would be great.
So what about a new instrument?
I'm a big fan
It's
of
called
new instruments.
revenue-based financing. It exists. Revenue-based financing. It exists all over the world. It's a great idea.
Okay. And
Yeah,
you
it's Ani's right. I mean, it is a form of revenue-based finance, right? Like, so there are versions of what you're describing, and there are also, I mean, one discussion we're having in the States, for example, is where the wealth inequality is so huge, right? Like the average wealth of a white family is $150,000, and the average wealth of a black family is like 1/14 of that. And in some cities, like in Baltimore, the average wealth of a black family is $8, like single digit $8, right? So in a country like that, in a situation like that, what's missing is what's basically the friends and family round, right? Like a lot of entrepreneurs have the ability, if you come from a moderately middle class type background, you can probably, a lot of us could tap either our retirement savings or our literally friends and family. And if you don't have that, you're already starting from this very, very unfair disadvantage. And so there is a discussion that we're engaged in, for example, around this sort of idea that, like, why don't we do $100,000 to $200,000 entrepreneur startup grant, essentially, or, you know, here, go do this, right? And then you pay it back if you can. And so I think that is the kind of instrument that I think we will want to create or talk about more, especially in countries where you're starting off with this huge income and wealth inequality to begin with. And there are some interesting opportunities how you would structure that in different jurisdictions, right? So that entrepreneurs can afford to quit a job, for example, right? And pursue their entrepreneurial idea and get that initial, you know, like be able to buy out their own time, essentially, to focus on the entrepreneur. I mean, and I say this with some latent rage. When I reinvented myself as an entrepreneur in my late 30s, early 40s, I did meet with some VCs who would say things like, "Don't you think you're paying yourself too much?" I said, "I'm not 25 anymore and can live on ramen noodles, right? I have a family and my husband is a nonprofit filmmaker, so guess whose salary is important here?" And it was just like complete, you know, like there was this part of the Silicon Valley myth is that you have the hustle, right? And everybody is 23 and sleeping on couches. Like, no. What about those of us who actually have pertinent life experience in industries that we could help transform with our innovations and enterprises? And so that idea of like, here's your startup grant, go and do something useful and then pay it back over time is an interesting one. And that keeps coming up. I think that's it's an interesting challenge, I think, that a lot of early stage purpose companies have. Like that where is that equity-like thing that helps us get these companies off the ground in the first place?
I very much agree with what you said, and I would like to add to that there's also an inequality of industries. Like, usually, if you develop a new tech solution, it's way easier to find a lot of money for that than if you're coming from a social science background. For example, if your new solution is not fancy new high tech, but rather low tech, but maybe more efficient. And there it's often very, very hard to get money for your solution, and you're just try to survive with it and you don't get any money and you can't really do what you need to do. So totally agree, would be good to have new instruments.
Sorry, can I just add, there is an organization that is doing this. I'm sure, Astrid, you know them, but Will from Chisos Capital is doing that into individuals, investing in them, and then with the repayment. So it's just worth saying. So Chisos, CHISOS.
Yeah, there are a bunch of.
I have a question about the role of the state and public sector funding. So we had this morning a lot of pressure on policymakers to adopt a new legal model, which by its design will really limit the pool of available capital for the kind of purposeful steward-owned companies that we're all talking about. And we know the private sector has a certain mentality. So I'm interested in the panel's opinion on, is there a role of the public sector in terms of being a funder as well as a legislator? And what could that look like in a dream world in your mind?
I have opinions, she says, and reaches for the mic. So in the US, actually, the National Science Foundation did something really clever. They're the people who underwrite, basic research to send people to the moon or whatever. And they rebranded this really boring sounding program called the Small Business Innovation Research Grant. And they're now calling themselves America's Seed Fund. And you can go in there as an entrepreneur. You have to be domiciled in the US and basically get a $275,000 startup grant in a project like phase 1. And then they underwrite potentially a second round, and then they potentially come in on a third round to match any private investment. I think that's one of the sort of the beginnings of a really thoughtfully designed program that actually contemplates what the handoff is to private investment down the line, but where the state is taking this very active, actually harnessed an existing institution and even an existing program to make it a little bit sexier for 21st century entrepreneurism. So I think that's a promising approach, and I think there's some other things. Just in the breaks, we were deliberating things we could do with like stranded assets in German bank accounts, for example, right? I think your home country, the UK, set up a whole financing system for entrepreneurship, basically using people's left behind wealth in bank accounts. And so I think, all eyes on the German coalition government now, right? For how it's going to translate its promise and aspirations there.
And I think we could start with the public-private partnerships within that field that already exist, that have or who have the task to support those companies, but have a structural disadvantage for any form of diversity within those companies. They're very much focused on the streamlined VC model. If you bring up the HTGF today or any other of those and say, I want to be steward-owned and I want to design this crazy debt-like structure, you're out. And that's public money that flows in there, right? So I would say let's start by those and make them not create more advantage for steward ownership, but let's get rid of the disadvantages, the structural disadvantages that are out there. That would be a good start.
I would just add, bringing this back to the point around this being a potentially new, different asset class, right? An alternative asset class, where venture capital has a few huge winners that drive all of the returns, and a lot of companies that fail, and all in all, it's supposed to come to balance out and generate 2-3x on the portfolio. And what we're trying to do is do enough of these to generate kind of a portfolio portfolio level data around what does the distribution of outcomes look like, and it doesn't look like VC. It's hopefully a lot more dependable. It's not this barbell approach or power law distribution. It's much more kind of a normal distribution, and what does it look like, right? And really generate the data to then attract these more institutional sources of capital. So I could see whether it's philanthropy, whether it's public funds, playing a role in de-risking those early experiments, right? If you create a fund that's dedicated to investing in this asset class, a tranche, a subordinated or sort of first loss tranche from government could go a long way in helping other private investors join in at this experimentation phase.
I think having some more players within that field with intentionality on the investor side I would be curious to see more innovation on that level as well, to find out people who we think have a strong connection to certain areas or have something within them where they are, have a good expertise, and give some money to them to then make the decisions within those fields, and stop creating buckets of money where we then hire managers to just manage that buckets of money for themselves, but bringing some intentionality within that field. I have no idea how to do that, but I think there's a lot to invent within that field to make it a lot more lively and reinvent that bucket system there.
I am Jan here, a zebra from Paris. I'd like to give some hope, and I'd like to tell you that recently, I asked someone from the Banque Publique d'Investissement, which is the investment public bank, which is matching 50% of all the private investment in companies in France, how much of the total billions were invested in impact. So that was just impact. It is 3%. So there's so much room for improvement. It means you have 30 times more chances, if you are not impact, to get money from our public bank. And I think there's a lot of public and consumer and taxpayers pressure to put on our governments to at least equalize between impact and non-impact. There's no reason why we are so underrepresented in public financing. And the second element of hope is that we have a steward-ownership VC fund in France. It's called 2050. .do. I really invite you, if you are looking for aligned investor, to have a conversation with them. They invest all over Europe, and I disclaim that I'm one of the LPs because I was really actively looking for such an alternative way of building a VC fund, and they did it, Marie Eklund and Olivier Mathieu. So I hope that all over Europe we will see more and more of the steward-owned VC and investment firms, because I do believe that we founders, entrepreneurs, we need to be aligned also, if we are steward-owned, with investors which are also into that direction, to rebalance the power and to kind of build role models for the future. So thank you for listening to the French twist.
We have time left for 1 or 2 questions. So.
Hello. I was handed the microphone. Another zebra here. Hi, everyone. My name is Mo. Question about demand and supply. So we work with we're a growth marketing agency for good that works only with other zebras to help them grow. And that's usually either before funding or after funding. And I still feel like everyone's needing finance, and they're genius, predictable, profitable models that are really struggling to find the right alternative finance partners. So from your experience, all of you, like even just compared to the normal VC or startup world, compared to this alternatives, I guess, zebra/purpose world, what's the difference in supply and demand of finance? Do we have enough money for all the zebras?
That's a good question.
No is the simple answer,
Yeah.
I think, right?
And when is it going to happen?
Well, yes is the simple answer. We just don't have the plumbing on air, right?
Yeah, I mean, there's a lot of this, as I described, this friction, right, of having the ability to even sort of come together. If you're a company, I'm an investor, our starting point, figuring out the right solution for you. There's a lot of friction in that process, right? And I would add too, there's something like inherent again about this model that is with venture capital or angel investing. It's fine to like, hey, whatever. Like, I think your idea is cool, and you look like a founder with hustle. I'll write you a little check. If it fails, fine. That's totally part of the model, right? That is. It's sort of a different mindset here around, well, wait, this is kind of closer to death. We have to figure out, is this actually going to work? So it's all kind of moving more slowly. So there's something kind of inherent there as well.
For me, it's a chicken and egg problem, because I wouldn't want to invest into a company because it's steward-owned or Zebra. It got to be attractive. And I think the more Zebra and steward-owned companies are out there that are attractive for investors, and the more they notice that they can't be part of the deals anymore, if they're not open enough, then it'll slowly change. I hope quicker, but we're just at the start, I feel. But there are funds like Joshua's in the audience, Mazawa, who commit to like opening some of the fund, even if you don't change the whole structure, committing like some of the funds to enable yourselves to, if they are attractive enough, to do that. So I think that's a start as well, to not be either Zebra or not, but to have those like, I want to look for great entrepreneurs and then have the opportunity to do both. That's a good start, I think.
I think there's a couple of interesting points of friction here. One is, I think it's a massive coordination problem, right? So with all the diversity of different purpose-centered businesses, and then the interest by investors to invest outside of the VC and sort of banking type models, it's basically a many-to-many matching problem. And so that you feel that as an individual entrepreneur because your search time just went up exponentially, and you really don't have that time. And so, but it's really difficult, right? Like trying to find a purpose-aligned investor, I do believe, is much harder than trying to find just a regular old VC. Mm-hmm. And then the other thing is that point I was sort of making tongue-in-cheek about the missing plumbing, right? So what we see is, for example, and Arnie mentioned Will Stringer at Chisos, which is one of several exemplars of a new crop of revenue-based funds. And they're all single or maybe double-digit million-dollar funds, and several were for. And here's one. I'll tell you a little ironic story. Kaufman Foundation in the U.S. supported several of these funds. Right? They had a catalytic capital lab or whatever they called it, and they invested in a bunch of these revenue-based vehicles, who then went out and invested in the types of entrepreneurs we're talking about here. Well, come to find out, right? And that was a several million-dollar program. Yay! You supported 10 new funds. Great. Talk to the chief investment officer of the foundation, and come to find out her rules were, which she is bound by, right, by the organic documents of the foundation. She could not write a check that was smaller than 1% of her endowment, which at the time was like a $25 million check, was the smallest check she could write into a fund. And second important rule, that was a major constraint, is she was not allowed to be more than 10% in any one fund. So you do the math, right? The smallest fund she could invest in is a $250 million fund. Doesn't exist. There is not a $250 million revenue-based fund in the world, to my knowledge. So that's the missing plumbing, right? And yes, the capital is there. There's over $1 trillion of it sitting on the balance sheets of US foundations alone, and a lot of these institutional investors are bound by these silly rules. So in part, again, that's where at Zebras we sort of look at like, what can we blow up to build what new plumbing can we build? What do we need to blow up, and what do we need to build to help the existing capital flow in a useful direction?
Kind of been in a channel for that.
Yeah.
Thank you. Arnie, you wanted to add something to that? I was not sure.
Yeah, I would echo what everyone's saying, and I also am working on a couple of projects right now that are designed to do that. I mean, obviously, the part of writing the book was because I sensed this frustration, and had been alongside Astrid and Anair, for years, just frustrated that there weren't more funders. So you go out, and I work with funders and with founders, and you go out, and just like in this audience, people are like, yeah, this is all great, but where's the money? Like, you told me all these things that I could do, but it's hypothetical. And so I think that, the plumbing is exactly the right analogy, and it's also the plumbing and the education. So, sometimes when I do presentations to large groups of funders, they are just, this is incredible, we want to be able to do this, but, we went to our lawyers and they came back and they told us it wasn't possible. And so I think that what each of us have had to do over the years is that try and identify the greatest obstacle and try and fix it. I mean, Astrid has done incredible work with, Zebras Unite, and has been, a home for many, many organizations. Anir has just been building these instruments and then, doing them and writing about them. And so for me, some of the stuff I've been tackling is around the legal and the tax and the regulatory and the really boring things that people say are issues and either need to be fixed or are actually not issues. And so I think that where we are right now is we're very much in the chaos of a market formation where there are a lot of players and there are a lot of obstacles, some real and some perceived. And so it is only through kind of pushing through this that we're going to get to the point where there's not just enough capital out there, but the capital is able to actually meet the entrepreneurs. And one project I would mention that I'm working on that's going to hopefully help with that is with Village Capital using their Abaca approach, which is investment readiness tool, mostly US based for now, but will be expanding to be able to help integrate some of these alternative structures into that investment readiness. And it's something that, I'm really passionate about, just helping to integrate into incubators, into any sort of investment programs, having this alternative set of options that sits beside VC into, banking. There's just, what we need to do is we need to make sure that all of the different parties around the table understand that there are different options. And as Astrid said, start to build that plumbing to be able to make those options slightly easier to do. So it really is about, just putting those puzzle pieces together. And there's no easy answer for entrepreneurs in the audience to say, this marketplace is the place that you go, unfortunately.
Thank you.
We have no time, unfortunately, for the next questions, so we have just 10 minutes left, and I suggest that we just finish with one question of mine, just as a last round. So I'd like to ask you guys, when you look at the idea of steward ownership and at the alternative finance, what seems to you to be the next steps for this idea, and what is the change that you really like to see in the world for this idea, like as the next one?
Well, I guess it needs to become mainstream. And here I think it's really important what you said before. It's not that this is a one-size-fits-all solution and we're now working on it replacing everything else. But we need more alternatives. We need this society, this economy, to become more sustainable, and for this we need new options, and we don't need them in a niche of like-minded friends. We need them in the broader public. So I just want to thank you all, guys, because you're all pioneers working in this, and being a pioneer sometimes sucks because it's exhausting and you get nowhere and you have to explain everything 10 times, but you're really doing important work here, and I'm sure that there's going to be a tipping point at some point, very soon, hopefully, where this movement just gets big enough that it's going to get mainstream. And I think that's when we're really about to make major changes.
A very loaded question. I'm thinking of something great, but I think we need to keep exploring and creating examples and just do the hard work to find out. And I think the second one is maybe follow the money and look like where are the ones who are actually making decisions, and educate and talk and see, like, do they know the options? Do they know that there is diversity, and understand who makes those decisions where and how?
Kind of really practical approach.
You know me,
good. I like that.
Yeah, one topic I touched on, but didn't talk much about is around just the inclusion of stakeholders in this structure, right? In terms of decision making and in terms of the value creation. And so, a couple of the deals that we did had very explicit kind of like formulas, right, around at what point does the investor get some fixed return, some dividend, and then once that happens, how value gets shared between investors, workers, maybe other stakeholders, suppliers, customers, allies. And so you end up with a really cool, very tangible way of showing, well, this company did really well, right? It generated, 10 million in profits, and here's how it got distributed, right? And we as investors made a return that we're happy with, but guess what? Our return was only 10% of all that value created, and we can show that, right? 90% went to workers and other stakeholders, and so to me, that kind of gets at sort of a really tangible way of showing, this is a kind of this non-extractive model where if we succeed, we are lifting all the stakeholders in a meaningful way.
What's next? Well, I actually want to pick up on something and say to the entrepreneurs in the audience, you're awesome. And also, I'm so sorry you're doing this at this moment in history, because it is really, really hard to find the aligned capital. And we see this at Zebras Unite all the time. Like, people go like, where do I sign up for the co-op? And how quickly can I get the check? I'm just like, doesn't work that way. We're still figuring out how to navigate you, even build the plumbing internally to navigate you to the capital that's right for you. And it's going to take time. And some of you may run out of runway before some of us on this stage and on the screen figure out how to make that easier. So this is a very exciting moment in history and also a very difficult time to be an entrepreneur. And with that, what's next? Well, a few of us are getting together tomorrow morning to figure out how to basically build the monkey wrench brigade for Germany and figure out what needs building, what needs blowing up, very pragmatically speaking right here, together with a few partners and stakeholders to address this issue of how we unlock, how we build better plumbing, I should say, for the capital to flow.
So
come on, guys,
I too hope that the next step will be mainstream, and I think this has this political component that I hope more and more people will understand, that like the next version of democracy should be something like with a more democratic access to wealth and also capital for entrepreneurship, and more practical. I think one next step could also be to make it easier to get like crowdfunded money, because I think there are much more people with like smaller tickets who would be interested in investing in companies like these. So I think this would be very helpful to have like a better tools for that.
So going more in the direction of democratizing the processes and making it more accessible for a broader audience.
Yeah, because my impression is it's much easier to convince people with a small amount of wealth that this is like a good way of investing than convincing like the big funds or the very wealthy individuals.
What about you, Oni?
So I agree with everything that was said. And I really think that our current investment processes are generally gender biased and racially biased. They're exclusionary, they are not integrated with impact, they are driven by funders' priorities, and they are extractive. And I think that what we're talking about is investment that is inclusive, impact-driven, wealth-building, and founder-centric. And I think that, as Astrid has said, we need to rethink the entire investment process, from sourcing deals, due diligencing deals, how we structure deals, the types of ownership, as we are all talking about here, and how we exit deals. So I think the next step is, I agree with the mainstreaming, and again, that bifurcation that I see of the mainstreaming of some of these concepts, but at the same time, then going back, and as Astrid said, the blowing up of the systems that are, just not working for us. And I think really I would say to everyone in the audience, like, this is the time, as Astrid said, in this moment, to be courageous and to be brave, because no one knows what they're doing. And there are no rules because they're being written. And so it's up to us to design the type of investment and ownership structures that we want to see.
Yeah. Thank you so much, guys and ladies, for joining us today. And it was really, really amazing to have you as panelists and to hear your perspectives on this topic. And yeah, that was a really inspiring discussion also for me. And I think it's great to hear what's happening in the world in the field of alternative finance, and to see how things are changing compared to a couple of years ago. Also thanks to your job, your contribution, guys. It's really amazing what you are doing to contribute to this field. And of course, still we have some challenges here, and still we have some catching up to do to develop the right tools and solutions, but also to blow up with systems that do not work for us anymore, to look for systemic changes and talk to the politicians about that and so on. But also it just needs time, and it's like something we have to consider and keep in mind. Yeah, as you said, it's like it needs time. Yeah, and we have to be brave. Yeah, but I'm really excited to continue working on those alternative solutions and topics with pioneers like you guys. And thank you for your time. Thank you for joining, and thank you for coming. Bye bye, Oni. Thanks.
Bye bye, Oni.